Good afternoon, friends. We are honored to have Shri Saurabh Soparkar sir as our next faculty of the day to throw the light on recent important judgments on business income and capital gain. I request our MCM, Shri Sunit to escort sir on the dais. Welcome, sir. So, welcome, sir. Yes. Although each of us knows her very well, but still, before the session, I would like to give a brief introduction of Sir. Sir is a senior most advocate of Gujarat High Court and Income Tax Appellate Tribunal, practicing since 1981. Sir is also a past president of Income Tax Appellate Tribunal Bar Association. Sir was fantastic at academic as well. Sir secured third rank all over India in CA final and first rank in Gujarat. Sir is also a member of various universities, Ahmedabad University, SAPT University, and Ahmedabad Education Society. So without taking much time, I would like to call Mr. Sunit Shah to give memento to Sir. Sir, please. Sir, I would like to invite you on the dais.
Good afternoon, friends. It's a pleasure to be here. All of you are here to make up for the CPE for the year to end. But then that doesn't really mean that you are here only for the purpose of scoring the hours. I'm sure you are also here to understand and appreciate some of the nuances of some of the recent judgments. There are two ways of dealing with this topic. Usually I start with whenever I'm talking on this issue. One way of doing it is to give the long list of the judgments in recent past, touch them, hurriedly deal with them without really analyzing them. Now, you can all open index of ITR, go through it, and obviously that is how you will come to know. I do not discuss this topic from this perspective. I usually take up 8-9 judgments, discuss in detail so that we will appreciate as to how that judgment is likely to affect us. How can we use this judgment, or how can we avoid getting trapped into the four corners of the judgment which is against the SSC. So I will be dealing with about 8 to 10 judgments in about 60 minutes, and if time permits we will have some question answer. I start with one judgment which is of a very, very recent origin, less than 20 days back, in the matter of Jindal Steel and Power Limited. This judgment deals with how do you compute benefit of deduction under section 80IA4 in the matter of transfer of power from an eligible unit to an ineligible unit. This issue is being discussed since quite some time. Various high courts had decided in favor of SSC. But the angle with which Supreme Court has approached the matter is extremely commendable one, and I would get into this for the purpose of discussing with you the contours of the controversy. Let's first go to the facts. This is the judgment reported in 157 textment.com 207. SSC had a manufacturing division. SSC required power to run that manufacturing division. Therefore, it set up another captive power plant. Captive power plant would supply power to this manufacturing division. Captive power plant, when it finds that the power required by manufacturing unit is not good enough to meet its supply, the excess power would be supplied by the captive power plant to State Electricity Board by virtue of a separate agreement. Now, State Electricity Board was buying power from the eligible unit at rupees 2.32 per unit. But State Electricity Board was selling power to whoever wants power at rupees 3.72 per unit. So SSC, the power plant, was selling power to the Electricity Board at rupees 2.32. But when it came to supply of power to the manufacturing division, it claimed, I am supplying power at rupees 3.72 per unit. Question that arose was whether SS is right in claiming that the price at which it has supplied power to the manufacturing division is the market price. Now, in the ultimate analysis of profit and loss account, obviously it would not matter because it is interdepartmental transfer. But then, if it is sold at rupees 3.72 per unit, obviously the realization is higher, considering cost, profit is higher, and that profit was wholly exempt under section 80IA. Revenue said you are trying to increase the profit by showing higher profit, and therefore we will reduce the sale price from rupees 3.72 to rupees 2.32 per unit. Now, if you look at section 80IA, subsection 8, below that there is an explanation. The explanation says that any transfer of goods or services will have to be done by the eligible unit to a non-eligible unit at the market price. Therefore, if you are doing it at a price higher than the market price, then the differential will have to be ignored for the purpose of section 80IA4. Case of the revenue was market price is rupees 2.32 per unit, not rupees 3.72 per unit, because the very unit is selling to us, is selling to a State Electricity Board at rupees 2.32. If it is selling to State Electricity Board at rupees 2.32, how can it claim that it is selling to the non-eligible manufacturing unit at rupees 3.72 and that is the market price? The argument of the SSC was, if manufacturing unit were to buy from Electricity Board, it would have paid rupees 3.72. Therefore, the market price of the electricity is not rupees 2.32, it is rupees 3.72. Therefore, the question was, how do you define market price? The Supreme Court says, what is market price? Market price is the price which is to be found in a market. And what is market? Market is a place where the goods or services are purchased and sold in competition. In order that a price is a market price, it has to be a competitive price. It has to be a price at which you can buy or sell goods in the market. Any private arrangement which is vitiated because of the arrangement being not a free arrangement, not on account of any competitive element, would not be the market price. The court said, and that is the reason why I am saying Supreme Court judgment goes quite beyond or far from what most of the high courts have held. The price at which the SSE sells power to electricity board is not the market price. It is not the market price because A, it is decided under section 43A of the Electricity Act and 1948. It is decided by the regulations of the government. SSE has no option to negotiate. If this is a government fixed price at which SSE has to supply power to the electricity board, that cannot be regarded as a market price. Market price is something which is on the basis of free competition of buyer and seller. This is not an open market price. Court then says, look at the alternate situation. What is the price at which electricity is available in the market? Now the manufacturing division itself is buying electricity from electricity board at rupees 3.72. If at rupees 3.72 power is being purchased by the manufacturing unit, why would that not be the market price? If manufacturing division's purchase of electricity from the electricity board at rupees 3.72 is found to be valid, because that's the correct market price, then obviously 3.72 is the correct market price. In other words, not the price at which the electricity board would purchase, but the price at which electricity board would sell would be the market price. The purchase price is not a free price. It is not an open market price. It is not a price derived on the basis of competition between the parties. Whereas sale price is the price at which the goods are available freely in the market. Whoever wants to buy electricity from electricity board will apply and he will be given power at that particular rate. So this is the market rate. In other words, the Supreme Court has explained what is the open market rate. In every situation, wherever we are concerned with this problem, we will there have to find out as to whether the price with which revenue wants you to compare the price at which you are selling the goods, is it fixed on the basis of some regulation? If yes, that would be irrelevant. Let's look at a couple of situations relevant for our purpose. Now the law is amended. Law is amended in the sense, explanation as you would recall two clauses. One clause is the market price. The second clause says, wherever the transaction is governed as a specified domestic transfer, then the arm's length price determined under section 92F clause 2 would be the price at which the transaction would be carried out. Therefore, the question would be whether the judgment would continue to hold field even today. Can it be argued? Because in every case now that you have section 80 IEA 4, these will be all cases of specified domestic transaction. Effective from assessment year 13-14, you will have to go by the new definition or the alternate definition of arm's length price. Now, the beauty of the judgment is even this aspect would stand answered. Because if you look at the definition of arm's length price under section 92F clause 2, it says price at which goods would be purchased and sold by unrelated parties in an kind mark uncontrolled situation, uncontrolled condition. So if the transaction is being worked out in a controlled manner, then in any case it is irrelevant for the purpose of finding out arm's length price. Now, for the reason which I gave, namely price at which power is purchased by electricity company or electricity board is a regulated one, it's a controlled one, it's a state-sponsored one, it would certainly not fall as arm's length price under section 92F clause 2. Therefore, the second part of the definition of what is the market price under explanation below subsection 8 of section 80 IA would also not be available. Therefore, this judgment would continue to hold field notwithstanding this amendment in law. The second issue that might arise, now power is available freely for anyone to buy through power exchanges. So revenue has also become smarter. Revenue claims, whereas you are selling, let us say, at rupees 5 per unit, on this date, on the power exchange, the power was available at rupees 3 per unit. And therefore, we will ignore rupees 5, we will go by rupees 5 per unit. Sorry, we will ignore rupees 5 per unit, we will go by rupees 3 per unit. Therefore, again, whether the price at which the power would be purchased and sold on power exchanges would be relevant or not. Now, power exchange is a market, and the price at which power would be purchased and sold on the power exchange would certainly be something which revenue may be entitled to draw. But, and this is probably the reason why this judgment also will have to be used. Whereas my supply from an eligible unit to my own ineligible unit would be on a long-term basis, power to be purchased and sold on the power exchanges would ordinarily be on one-to-one basis on a temporary requirement. Today I run short of 10 megawatt, I'll purchase power from the power exchange. And then when you are buying and selling on spot basis, you can't compare the price of goods being bought and sold on spot basis with the price of goods purchased and sold on a long-term contract basis or a long basis. And therefore, that market is not this market. When we are considering which is the market to be considered, even this aspect may have some relevance, and therefore, this judgment may have to be utilized for the purpose of ensuring that you don't really lose out on a benefit under section 80 IA on the ground that you are charging higher than the market rate in relation to goods in question. Let me now go to another recent judgment of significant importance, and that is in the matter of Bharti Hexacon. What is the controversy and what is the view? All of us are aware that so far as telecommunication companies are concerned, they are permitted to give telecom services after obtaining license. Now, the government charges hefty fees for the purpose of issuing license. There was a policy of 1994 under which the licenses were given for a fixed sum which was to be treated as a capital expenditure. In the year 1999, government changed the policy under which the two-tier system was introduced. A small amount to begin with to get the license, and then on the basis of your turnover of every year, you pay license fee of 15%. Therefore, let us say in year 1 to obtain license, you pay rupees 10 crore. And then depending upon your turnover, let's say your turnover in year 1 is 100 crore, you pay 15 crore. Year 2 is rupees 200 crore, pay rupees 13 crore, so on and so forth. Question arose as to whether such license fee is a capital expenditure or a revenue expenditure. EO said it's capital, SA said it's revenue. Ultimately, matter went to Delhi High Court. That's a lead matter. Delhi High Court took the view that insofar as the first amount of rupees 10 crore is concerned, because it is for the purpose of obtaining license, it's a capital expenditure. But so far as yearly payments thereafter, because they are percentage of revenue, 15% of revenue, they would be treated as revenue expenditure. In other words, fixed fees were capital, variable fees are revenue. It was this issue which was carried by the revenue to the Supreme Court. Whoever wants to understand, appreciate, get knowledge, and in the process get confused about what is capital versus revenue expenditure must go through this judgment. It's an encyclopedia of all judgments on the field till today. More than, I think, 100 judgments are referred to. Every judgment of Supreme Court, every judgment of, not large number of judgments of English court, large number of judgments of high courts are considered. SSC has lost, and the view that is taken is even a yearly fee would be treated as a capital expenditure. We must appreciate as to why that is said so. I am not worried about the telecommunication companies losing or winning. We are concerned with the principle, because it is this principle which might hurt us in the years to come unless we are careful about drafting of a document. As I said, all earlier judgments of the Supreme Court are considered. Then the Supreme Court lays down what are the relevant tests. I'll just give you the list of relevant tests. Supreme Court then lists down what are irrelevant tests. After laying down what is relevant test and what are irrelevant tests, Supreme Court draws conclusion. So I will first go to relevant test, irrelevant test, then the conclusion. Supreme Court says, so far as relevant tests are concerned, whether amount is paid for once or on a year-to-year basis is a relevant factor, though not conclusive factor. What is the object of the expenditure is required to be seen. Does it give you an enduring benefit? Again, in past, Supreme Court has taken a view, like for example, Empire Jute, that even if it's an enduring benefit, it may still be in the nature of revenue expenditure. Alembic Chemical, Supreme Court had taken a view, even if it's an enduring benefit, it may still be revenue. Supreme Court says this is again a matter to be taken into consideration. Whether the expenditure gives you a commercial advantage of a longer duration, again that's important to be taken into consideration. What is the effect of this expenditure on your profit making apparatus? Does it increase your earning capacity, or does it only help you in earning without increasing your strength or capacity to earn? After laying down these principles, Supreme Court lays down tests and says these are the positive tests, namely to bring into existence, if it's a new asset, it's capital. If it's an initial outlay, it's capital, but if it is subsequent, it is not. If it's a fixed or a circulating capital, if it's a fixed, it's capital. If it is circulating, it is revenue expenditure. Enlargement of permanent structure. Then whether it is for the purpose of day-to-day activity, revenue. If it is done for the purpose of commencement of a new activity, it is capital. After laying down this principle, Supreme Court then lays down 3 negative principles or 3 irrelevant factors. As I said, lump sum or a periodical payment, though it's relevant, it is not conclusive. Therefore, don't go by whether payment is to be made at once or over a period of time. Second, magnitude of payment is irrelevant, whether it is 1 rupee or 100 crore. Don't go by the amount that is involved. Go by for what amount is paid. Third, entries in the books of accounts are irrelevant. In your books of account, you may treat it as revenue, it may be capital. In the books of account, you may treat it as capital, claim depreciation, and yet it may be of a revenue nature. Therefore, don't go by what is an entry in the books of account. The Supreme Court then lays down the principle that in view of this, now applying the facts, the SSE purchased license. The license entitled the SSE to do business for number of years. It is true that for the purpose of doing business for a number of years, payment was also required to be made over a number of years, and the payment was to be made as a percentage of revenue. But that does not in any way mean, Supreme Court says, that it is not for the purpose of acquisition of a license. But for license, you can't do business. And if you cannot do business without license, then whatever is the amount that you have paid for acquiring license is a capital expenditure. Whether you pay at one go or whether you pay over a period of years, you will have to treat it as a capital. The argument that it is dependent upon, the amount of expenditure is dependent upon percentage of revenue or as a percentage of revenue, Supreme Court says again that is not material. Find out why you have made the payment. If you have made payment to acquire a capital asset for the purpose of business, then it is a capital expenditure irrespective of how and why, in what manner payments are being made. In this process, Supreme Court was called upon to examine quite a few judgments of past. As I said, Supreme Court has considered more than 100 judgments. Supreme Court says, in a matter of this kind, do not go by matching facts of one case, one decided case, with the fact in your hand. You will have to examine your facts completely, individually and independently. And it's only when you find that facts are identical to another decided matter, you can follow that. In other words, the principle laid down by the Supreme Court is, one, any expenditure incurred by you for acquisition of a capital asset with which you start business, which is towards the foundation of your business, is a capital expenditure. And merely because you find that payment is to be made over a period of years as a percentage of revenue is completely immaterial. The moral of the story of this judgment is, we always have been subconsciously taking a view that if an expenditure is related to my income, as a percentage of my income, like royalty, like some tax, like some fee, it has to be taken as a revenue expenditure, because higher the income, higher is the expenditure. So obviously it's an expenditure incurred for the purpose of earning income. Section 37 would apply. I must get it as a revenue expenditure. Supreme Court breaks this myth. Supreme Court is very clear, don't go by the periodicity of the judgment. That is not material. Go by the purpose of making payment. And therefore, if you are now in the process of acquiring an asset, acquiring a capital asset, acquiring some kind of business right, you need to be conscious, cautious and extra careful to ensure that appropriate way of describing the particular transaction. Otherwise, what you believe might be a revenue expenditure might turn out to be a capital expenditure. This judgment, I understand, has put all telecom companies into huge problem, because they had claimed revenue expenditure running into hundreds of crores, and suddenly they are being told this is not to be allowed to them. I don't know what is going to be the financial implication. But this is one judgment which is a very, very important judgment from the perspective of business income, especially in the matter of capital versus revenue expenditure. Third, which is not strictly versus capital versus revenue, but what is important from our perspective is, because it lays down a very, very interesting and important principle, and that is of Gujarat High Court. This is in relation to section 56(2)(7) or now 56(2)(10). It may also have some repercussion on capital gain, that's why I am covering it. What would be the impact of section 56(2)(7) or now 10 in the matter of issue of shares of a company at the first instance. Take a situation, there's an existing company, there are 4 shareholders, A, his wife, Mr. B and C. B and C are unrelated to A. The fair value of that share, fair market value of share under 11 UA is, let us say, rupees 200 per share. The company makes right issue at par at rupees 10. A acquires, let's say there is a right issue of 4 lakh share, each A, his wife, B and C are being offered 1 lakh share each. A takes 1 share offered to him. A takes 1 lakh shares offered to his wife, which is renunciation is transferred to him. A also takes 1 lakh shares offered to B, which are renounced by B in favor of A. Now, shares are offered at rupees 10. Market price is rupees 200. There's a difference of rupees 190. Question is whether A would be required to pay any tax under section 56(2)(7) or now 56(2)(10). If you recall language of section 56(2), it says where an individual or now any person receives in any previous year from any person any property other than an immovable property without any consideration or for an inadequate consideration. Issues were raised before the tribunal in past as to what would be the impact of such provision in the matter of right share. Revenue very clearly stated, revenue's position was very clear. What is 11 UA value? Rupees 200. What is issue price? Rupees 10. What is difference? Rupees 190. So if I am offered 25,000 share at a price difference of rupees 190, then I have got benefit of rupees 25,000 multiplied by 190, 47, or let's say 47 lakh. Case of the SSC was, but I am 25% owner, I am being offered 25% share, I take what is offered to me. By taking these shares, I am not increasing my holding. How would it matter? Revenue said no, it would still matter, you will be taxed. Similarly, shares renounced by relative or third parties, obviously there is a difference between the market price, 200 rupees, and issue price, 10 rupees, they were all subjected to tax. An argument was canvassed before Mumbai Tribunal in the case of Sudhir Menon. But sir, how do you invoke this section? Because this is for the purpose of transfer of a capital asset. When the shares are allotted in the first instance, there is no transfer of a capital asset. Tribunal did not believe it. Tribunal said no, 56(2)(10) will apply. But when you acquire shares to the extent they are to be made available to you, in my example, 25%, there is no benefit to you because you are entitled to 25%, you are holding 25%. But if any excess shares are taken by you, there is a benefit. Sudhir Menon was followed across the country by different tribunals. In Ahmedabad tribunal recently, the very controversy arose, and following Sudhir judgment, the Ahmedabad tribunal also took the view that section 56(2)(10) would apply, but it will apply only in relation to the shares acquired on renunciation of a third party. Your own shares or shares which are transferred to you by your spouse, relative, because transaction with a relative is not to be taxed, it will not really matter. This matter was carried to the High Court by the Revenue in a judgment in the matter of Jigar Jayantilal Shah, 154 Taxman.com 568. Gujarat High Court was called upon to decide the larger issue, namely whether section 56(2) at all is applicable. The argument on behalf of the SSA was a very simple one. Sir, look at the language of section 56(2)(7) or 10. When a person transfers an asset to another person at a price below the market price, this provision is triggered. Now, as accountants, all of us know, when a company allots share, nobody is transferring anything to anyone. I give rupees 1 lakh to company. Company takes it as its liability. For company, it is not an asset. Company, it's a liability. And company allots me share certificate for rupees 1 lakh. Who is transferring what to whom? Therefore, the argument before the Gujarat High Court was, following Supreme Court judgment of Khode Distilleries 307 ITR 322, which was cited in Sudhir Menon, but the Bombay Tribunal chose to distinguish it. But before Gujarat High Court it was cited, sir, look at Khode Distillery. Supreme Court is very clear that initial allotment is not equivalent to the subsequent transfer. When the shares are initially allotted, there is no transfer because shares are created and not transferred. So the term transfer would not include the concept of creation to begin with. Once shares are created and allotted, all subsequent transfers would be covered. But to begin with, the first transfer would not be covered. High Court accepts this contention and holds, in the case of initial allotment, section 56(2) has no application. Now please mark, this has nothing to do with right issue. This has nothing to do with renounced issue. This has nothing to do with whether I get shares because I was original shareholder or I am getting share for the first time. Section 56(2) itself will not apply in case of initial allotment. Therefore, let's say there is a company X of which shares fair market value 11 UA is rupees 200. Company chooses to allot shares to me at rupees 50 or rupees 10 for whatever reason. Revenue has always been trying to tax the difference as taxable under section 56(2). This judgment makes it very clear 56(2) will have no application. So, there has been debates in various commercial situations. You want to allot shares, but you don't want to allot shares at a full market rate because he's an employee, because he's a JV partner, because he's a person who is likely to benefit you, or for whatever reason. But there is always reluctance in allotting share at a price below 11 UA price because there is always an apprehension. The moment you allot shares at a price below 11 UA price, the shareholder would have to pay tax on the difference. Now, this judgment makes it very clear, for initial allotment, do not look at 56(2) at all. You can issue the share at whatever price you want. Undoubtedly, if you are issuing at a premium, at a price higher than 11 UA price, 56(2)(7) may apply in the hand of the company. But otherwise, so long as you do not allot shares at a price higher than 11 UA price, 56(2)(10) will not be or cannot be invoked. Relevant issue would be, in the case of the company allotting share, would there be a tax implication? Can revenue invoke any statutory provision by which company would be subjected to tax? Company's shares fair market value is rupees 200, company chooses to allot to rupees 10 to a third party. Let's say to me, I am otherwise not a shareholder of the company. Is it that I would be affected? I am not going to be affected, 56(2) will not apply. Would the company be affected? Now, the only provision under which, if the shares are transferred at a price lower than 11 UA price, that applies is section 50CA or 43CA. But in both the situations, the language of the section is, if the shares are transferred by one to another at a price below 11 UA price. So both those situations also envisage situation of transfer of an existing share by one to another. By the very logic of Gujarat High Court judgment, when the shares are initially allotted, there is no transfer because there is no one to transfer. Even section 50CA or section 43 CA will also have no application. Therefore, with the help of this judgment, it will be open for you to argue that in case of initial allotment, section 56 to 10 has no application and no addition is required to be made in the matter of such transaction. Connected to this or somewhat related to this is again a recent Supreme Court judgment in the case of BPL Limited, BPL 143 Taxman.com 222. It's a judgment under the Gift Tax Act. I will indicate why am I citing and discussing. It's under Gift Tax Act. Those of you who are practicing, who have been practicing since some time would know we had section 4(1)(a) under the Gift Tax Act, where there was a concept of deemed gift. If I transfer my property worth rupees 50 lakh to Mr. X at a price of rupees 20 lakh, 30 lakh lesser charge was to be taxed as a deemed gift in my hand. Something similar to 50C or 43 CA. Now, in the present case, what happened was the SSC was holder or shareholder of two companies. Both these companies were listed companies. Under the Gift Tax Act, if you are transferring shares of a listed company at a price below the quoted price, on the difference you have to pay tax, gift tax as a deemed gift. Similar to, as I said, 56 to 10, 40C, 3CA, 50CA. Now, SSC was holding shares of two listed companies. These shares were held in promoters' quota. In those days, and even now, if you are holding shares under a promoter's quota, you are prohibited from transferring them except to your group entity. So the shares were incapable of being transferred generally except to your group entity. SSC transferred these shares to the group entity at a price below the market rate. Let us say market value of these shares was rupees 1 crore. SSC transferred to the group entity at rupees 20 lakh. On rupees 80 lakh, deemed gift was applied and gift tax was sought to be levied. The argument of the SSC was, but then you cannot treat these shares as listed equity. Question was, what is the meaning of the term quoted shares? I am discussing this because now under Rule 11 UA also, you have concept of quoted shares. In case of quoted shares, go by quotation. If they are not quoted, then you can apply other formula. The SSC argued that, sir, these shares, whereas the share of this company is listed, quoted, the share which I sold could not have been sold on the market. If I could not sell the share in the market because there is a prohibition on transferring share to a third party, this share does not have a market value. Market value which is available on the floor of stock exchange is not the market value of my share, though it may be market value of similar shares of this company which do not have any such restriction. Supreme Court was dealing with the situation as to what is the meaning of the term market value. Supreme Court says market value means what is available for purchase and sale in the market. Market value would be in relation to that product which can be bought and sold. So far as these shares are concerned, Supreme Court says these shares are not capable of being purchased and sold in the market. Therefore, the principle of market rate would not apply. They would not be treated as a quoted share. And if they are not to be treated as quoted share, then the market rate will not apply. the difference will not be subject to tax as the deemed gift. Now this is relevant for our purpose because under section 11 UA, we have a difference between quoted and unquoted shares. If it's a quoted share, you have to sell at the market rate. If you don't do it, then obviously there is an implication in the hand of buyer, seller, 56 to 10, 50 CA, all those things will apply. Therefore, if you are able to demonstrate that yes, this is a scrip which is a listed one, but the share that I held had one or another peculiarity as a result of which I could not offload in the market, you are entitled to differ from or deviate from the market price or the quoted price. Now, this is a small issue. I am only looking at it from this angle, and probably one will have to consider from this angle. Today we are bound under section 50C to go by the Jantri value because that is deemed to be the market value. Can I draw support of this judgment to hold that, sir, it may be market value generally, but look at the facts of my case. I am not able to get the market value because of one or another problem. Land which I am selling has encroachment. Who is going to pay me full market rate on the encroached land? Land that I am selling has title disputes. There are court litigations pending. Land that I am selling is subject to leasehold right. Who is going to pay me for the land which is occupied by the tenant? If I can raise that submission, would it be open to me to argue that do not adopt 50C rate blindly? You need to find out market rate of what I am selling, whereas Jantri rate may generally apply to lands in the area on account of peculiar facts. It is possible for me to say that the Jantri rate generally applicable should not be applied. Can I argue? Probably this judgment opens a window. I am aware that some courts have taken a view. You can also argue before Commissioner Appeal that the valuation under 50C is not correct. But this gives you a handle or a support to say, don't go by the theory, Jantri price is final. If you can point out this is not final, probably you will have an argument to make to get out of that particular Jantri value problem. Let me now go to one interesting judgment of Karnataka High Court recently confirmed by the Supreme Court, and it is interesting for two reasons. It's MR Anandram HUF 450 ITR 94. 5 brothers had agricultural lands. The controversy is what is an agricultural land. 5 brothers had agricultural land. In the year 2004, they converted into non-agricultural land. But they continued to carry out agricultural operations. Though it was shown as non-agricultural land in the revenue record, they continued to carry out agricultural operation. They ultimately sold the land. Initially, they offered for tax capital gain of about rupees 50 crore. However, they filed revised return and said this capital gain is not taxable at all. And the argument that they canvassed was that this is an agricultural land. And if it's an agricultural land, under section 2 clause 14, it's not a capital asset, not subject to tax. Revenue raised 2 arguments, and both are important for our purpose. One, how can you treat it as an agricultural land when in the year 2004 you have converted the land into non-agricultural land? Look at the revenue record. Revenue record shows it's a non-agricultural land. And second, it is within 8 kilometers of a municipality. In that case, they were concerned with HADA. I think it is some area development authority. It's within 8 kilometers of that area development authority, and that is why it is not an agricultural land. It is required to be taxed. Matter goes to tribunal. Tribunal takes a view, interestingly before the tribunal SSC argued that, sir, today also on that piece of land, agricultural operations are being carried out. Probably even buyer did not put it to non-agricultural use immediately. So SSC said, sir, let's go and take inspection. Tribunal takes physical inspection of the land and it is found actual agricultural operations are carried out. So the High Court answers this issue by saying, whereas in the revenue record, the land is shown as a non-agricultural land, fact of the matter is agricultural operations are, as a matter of fact, being carried out. And if agricultural operations are being carried out, then the fact that it is described as non-agricultural land in the revenue record is immaterial. So the first principle that this judgment asks us to draw is, do not go by the nomenclature of the land in the revenue record. What revenue does is wherever land is described as an agricultural land in revenue record, revenue says, income tax department says, but you are not using it for agricultural purposes. And whenever the land is shown as non-agriculture, department says, in any case, revenue record says it is non-agriculture. You would now be entitled to say, please do not go by the nomenclature in the revenue record. Please see what is the actual position. We are aware that in the state of Gujarat, there is a restriction in the matter of transfer of land by an agriculturist to a non-agriculturist. So what is happening is, an agriculturist is required to take permission to convert his land from agriculturist to non-agriculturist, and only after it becomes NA land, it is being transferred to a buyer. Revenue always raises the contention, you have converted to NA, and now that you have converted to NA, it is not an agricultural land, and therefore after converting into NA, if you are transferring it, then you will not get the benefit of tax exemption. If you are able to establish that even after converting land into NA land, you continued to carry out agricultural operation right till the date of actual sale. I convert land into NA today, and let's say I sell it after 2 months. If I am able to show till the date I actually sold the land, agricultural operations are carried out, this judgment very clearly shows description in revenue record is immaterial. Therefore, the one positive point about this judgment is, do not go by the description in the revenue record. Second, that 8 kilometer issue. One was whether you take it aerially or otherwise. Now law is amended, so I am not going there. But the second, and this is again interesting, you compute 8 kilometer from what? Revenue contended it is within 8 kilometers of Area Development Authority, like AUDA. Even now, by and large, people say, but now that AUDA limit is extended, 8 kilometer will also get extended. So, lot of lands which were not agriculture, which were agriculture, will now become non-agriculture. Court says, language of the section for the purpose of 214 agricultural land 8 kilometer is 8 kilometer from the municipality. Municipality is an institution which has elections from time to time. It is self-governed institution. Area Development Authority is not a municipality. It's a regulatory body for the purpose of developing area in that particular, developing land in that particular area. Which would mean today, if I were to sell the land in the periphery of the city of Ahmedabad, I don't need to even look at AUDA. Whether it is within AUDA or outside AUDA is completely immaterial. I must look at whether it comes within 8 kilometers of the nearest Gram Panchayat, etc., having population. So, this judgment in a way clears a confusion which has prevailed for quite some time. It follows an earlier judgment in the case of T. Urmila, but says Area Development Authority is not material, what is material is municipality. This judgment of Karnataka High Court was recently carried to Supreme Court, and Supreme Court in 154 Taxman.com 143, after saying we find no reason to interfere, dismisses the SLP. I'm conscious dismissal of SLP is not confirmation of the judgment, but the way in which Supreme Court has referred to it, probably it is possible for you to argue that it is approval by the Supreme Court. So this is one issue in the matter of agricultural land. Let me go to one in the matter of capital gain, business income, both on the expenditure loss part. Especially now that we have businesses being run on a large scale, there are at times losses. Losses suffered on account of loans given, advances given, bad debt, guarantees, investment into shares. How do you treat all this? Now the issue was, this is a judgment in the case of Siemens Nixdorf, Bombay High Court, 114, Textman.com, 531, recently confirmed by Supreme Court, 453 ITR 741. The facts were like this. SSE lent 90 lakh euro to its associate, to its subsidiary. Subsidiary was in financial difficulty. It was not likely to be able to repay the money. That debt or the loan was likely to be irrecoverable. What SSE did was, it sold away this debt to a group company. Let's, for the purpose, that figure is not available for the purpose of understanding, amount recoverable was, let's say, rupees 50 lakh. It sold away the debt for rupees 5 lakh and claimed the difference of rupees 45 lakh as a short-term capital loss. The argument was, this is the debt which I am not able to recover and therefore it's a capital loss. The argument of the revenue is, a debt is not a capital asset. It's amount that you are given. It's not a capital asset. And if it is not a capital asset, you will not be able to claim this as a long-term or a short-term capital loss. SSE relied upon an earlier old judgment of Gujarat High Court in the case of Minor Bababhai, 128 ITR 1, where also loan was regarded as an asset. High Court, after detailed discussion, takes a view following Gujarat High Court that loan is also an asset. And if loan is an asset, if you suffer loss on account of non-recovery of loan, you are entitled to claim it as a capital loss. Revenue carries the matter to Supreme Court. As I said, 453 ITR 741. Again, Supreme Court, after a brief discussion, dismisses SLP. Now this will give rise to some interesting issues. I'm a businessman. I need rupees 50 lakh, so I go to my brother, request him to give rupees 50 lakh to me. He gives rupees 50 lakh to me. I ultimately am unable to repay. So obviously, that's a loss to my brother. This is a purely non-business transaction. Can my brother claim this loss as a capital loss? I am now moving from business area to personal area, because this happens quite often that you are given money to someone on a friendly basis, the man does not repay to you, you end up having a loss. Can you claim it as a loss? Because if debt is a capital asset and non-recovery of debt gives rise to capital loss, are you able to then claim it as a capital loss? Now, if you look at the definition of section 2, clause 14, capital asset includes property, whether connected with business or not. Therefore, the fact that it's a purely non-commercial private asset makes no difference. My brother would be entitled to claim it as a capital loss. Can someone argue it is a personal effect? Because personal effects are excluded. Now, if you look at the definition of personal effect, it includes ABCD, etc., which are required for personal use, Now, you don't require a debt for personal use. You might require money for personal use, but you don't require debt for a personal use. So it will not be a personal effect. The loss would certainly be available to him. And therefore, I was considering what are the possible situations. SSE gives advance to someone for the purpose of business. Ultimately, advance cannot be recovered. Whether the loss of advance is a bad debt, answer is no. Loss of advance is not a bad debt because it is not a debt in the course of business which is offered for tax earlier. Gujarat High Court has taken a view in the case of Abdul Razak, 136 ITR 825, debt, though it is not, bad debt it is not, it is a trading advance, it will be allowed as a business loss or a trading loss under section 28. If you are a guarantor for someone and in the business and as a result called upon to discharge your liability, would you be entitled to claim the amount that you have paid as a guarantor as a loss? Supreme Court takes a view in the case of SN Private Limited, 65 ITR 625, even that would be admissible. You have invested into the shares of subsidiary. Now the subsidiaries have become bankrupt, and therefore you are not likely to receive anything from the subsidiaries toward the share capital. Can you claim the amount of investment that you have made is a trading loss? Courts have taken a view that if you have made investment into subsidiary because of close business connection, forward integration, backward integration, supplier of goods or services, then it is a part of your business activity. In such a situation, Bombay High Court takes a view, Colgate 370 ITR 728, and Rajasthan High Court, Vaibhav Global 138 Texman.com 506, it will be allowed as a business loss. Now this judgment makes it clear that in any case it will be allowed as a capital loss. Therefore, this judgment in a way opens an avenue for the purpose of claiming losses as a capital loss, which may otherwise on a prima facie basis appear to be inadmissible. With this, as I said, I will be speaking for about 50-55 minutes. I have spoken for more than an hour. Thank you very much for patiently listening to me. I am very happy that you are here for this.
Substantial right issue, it will be taxable if it is at lesser price.
Sorry, it's not for.
Suppose if company issues the first share, then you rightly put, if it is not at the fair value, then it is not a transfer, then it will not be taxable. If it is a subsequent, because right is at the same price to all the stakeholders.
I think I was not clear. I'm not on first, subsequent, third. Every allotment made by the company, whether it's a first allotment or 100th allotment,
It is not a transfer.
according to this judgment, 56(2) will not apply, because in every case, it's creation of a share and not transfer of share. Yeah. Number one, Supreme Court has taken a view that there is no logic in the matter of treatment of the transaction in the case of payer and payee. Supreme Court took a view in the case of Empire Jute that the amount paid is a revenue expenditure, and at that time Supreme Court was told that, sir, in the hand of the recipient you have already taken a view it's a capital receipt. So how do you now take a view it's a revenue expenditure? Supreme Court said that is irrelevant. Whether what is his treatment is, I am not concerned, and there's a reason why. Let's say I buy flat from a developer, it's a revenue receipt in his hand. I buy flat from you, it's a capital receipt in your hand. I am a developer, I buy a piece of land, it's a revenue expenditure, though for you it may be a capital expenditure or capital receipt. But if I am buying land for my own purpose from a developer, for me it's a capital payment, for him it's a revenue receipt. So that's not really material on first principle. Secondly, if the vendor is in the business of dealing in the same product, dealing in the product, then whether he receives money at one go or over a period of time, it's a business transaction, it's a revenue receipt. So, answering your question, merely because it is capital in my hand, it should be capital in the hand of vendor, or vice versa is not there. Everyone will have to see what is the nature of receipt vis-a-vis receipt of payment vis-a-vis what he is doing. If it is possible to take a view that it is capital in nature, it will be capital, but not because in the hand of the purchaser it is treated as capital expenditure. That's completely irrelevant. No, I don't think the detailed judgment of more than 150 pages. And as I said, lot of judgments have been examined. It's a fairly exhaustive judgment on this particular issue, but they nowhere are suggesting that there has to be parity of treatment in the hands of both. But let us say a situation, if government is a trader of license, it goes on issuing licenses, it will be a revenue receipt in the hand of government also. It's a different matter. Government is not a taxable entity, therefore the issue doesn't arise.
Sir,
Suppose A is a developer, B gives 2 crore as advance to A for purchase of flat which are to be delivered at a later stage. Now, after 4 years, A is not able to deliver the flats and even not make the repayment of the loan. It would be a long-term capital loss?
I believe it will be long-term capital loss subject to indexation. You will be able to claim the losses.
Thank you.
Yes.
sir, a private limited company buy back its shares and pay tax under 115 QA. Will it be taxable in the hand of shareholder again?
The specific exemption is that 1034A, it's specifically exempt. Under section 1034A, there is no tax liability.
For limited and private limited both?
Yes, wherever company pays tax, shareholder has not to pay tax.
Okay.
It is not a double taxation.
Thank you.
Mukesh bhai.
This increase of this loan written off.
Sorry?
Advance given is written off. Is it not, it's a capital loss, but how do we claim it when there is no transfer? When somebody writes off an asset, namely debt or advance, how do we claim it as loss in the income tax return?
Look at the definition of transfer. Even extinguishment of right is a transfer. So I can take a view the moment I realize it is not likely to be received, and the moment I decided that I would not be receiving it, my right got extinguished. In a way, it's a unilateral act, but nonetheless, I can't be told that till you file a suit, till you obtain a decree, till you do not, you are able to show that decree is unexecutable, the taxing even doesn't happen. This similar issue arose in the matter of Jaikrishna Harivallabh of our High Court, where the argument was that till the last payment is made by the liquidator of a company in liquidation, you can't compute capital gain or a capital loss, because there is still a possibility of receiving something. High Court said nothing doing. This year, whatever you have received or paid, on that basis you compute. So that may not be a problem. Correct. One can. But I would suggest ideally transfer it to your son or your neighbor for 10 paisa, so that unnecessary litigation does not take place. You must show that you have transferred. It's much safer. But if you don't do it, I don't really perceive much of a problem. Unnecessary litigation can be avoided. Oh, once I'll give you. It's Karnataka High Court 450 ITR 94, confirmed by Supreme Court, or SLP dismissed by Supreme Court. 154 textment.com 143. Thank you very much. Yes, sir, there is a last one.
This telecom companies, then it will be very difficult to account for in the first year when
You account for whatever you have paid every year. You go on increasing the value of that asset.
then
Be-
depreciate, how to claim that depreciation.
I agree with you, but then Supreme Court says that according to the policy, you need to pay every year if you continue to do business. So it is in a way self-defeating contention that it is to be paid every year for the purpose of doing business. Why is it not revenue? But Supreme Court said that's a condition precedent for enjoying license. So it's a part of license fee.
Or can any hypothetical
How do we
figure,
know? Is it for
because
10
how
years?
to derive that profit for coming years?
Every year, the only way you will be able to do it is capitalize whatever you are paying during the year and go on claiming depreciation on incremental basis. That's a practical solution. There is no legal solution. Thank you.
Thank you, sir.
Thank you.
So we successfully come to an end of this day one national conference CPE. Tomorrow again we'll be starting with the second day. Sir, first of all, thank you so much, Saurabh sir. Every time he tries to spare time for our institute, for our members to share his insightful knowledge to all the members. On behalf of Ahmedabad branch of WRC of ICAI, I thank you all the members for their patient listening. Thank you so much.